So I think he very well covered the why and the what pieces of customer success. I'll be touching upon some more things around it as well. But I think one of the big questions would come up always is about how, right? Yes, this is good about I need to do this, and I know I need to cover these things as Anil said about customer success. But how do I look at my own data points? How do I look at more execution parts of it and make it happen? Other parts of it is more around how as an investor we would look at companies at different stages, and companies around $10 million, but the growth stage, which is more around $10 million, is focuses on, can you execute on these plans? Do you have a business plan which you're working on? Normally investors will back a business plan and not an idea, not a thesis anymore. And of course, beyond this stage goes into more execution, into more performance before you can go for an IPO or a sale of the business. So around this stage, which is where you are roughly around $10 million, you can do a lot more internal analysis of data you have, mixed up as people look at it. Normally people associate everything to accounts. So possibly we'll cover some of those thoughts around. So this is what I was referring to actually, right? So for example, at each stage, you will have a reason as to what gets funded, what do you have to achieve at each stage to get the next stage of funding, what do you properly look at from a value proposition perspective, what metrics normally, as investors we look at. And therefore, I'll focus today more on the Series C and D stage where you are around $10 million and you're trying to scale to $100 million revenue company. And we'll think about what all to focus on, but things are more around execution first, focus on a lot more on the GTM plan, a lot more on P&L metrics, and many things around which Anil mentioned about, whether it's NRR, whether it's about capital efficiency. So we'll cover some of those things. Very small presentation, 3 slides, so don't worry, but next slide, please. Now, generally when we talk about finance and accounts, most people associate it with just the first column, right? They think about finance and accounts being just accounting, bookkeeping, normally putting records of what you have done, and morally compliance, most looked at more as a cost center than anything from a business growth perspective. But actually when we look at finance, think of it as entire RevOps, which is primarily driving your customers, contracting. So think about as a founder, if you have discuss with the customer saying deal done, but the next steps are more around what are the next steps in terms of details about structuring the contract, invoicing terms, collection terms, rollout of it. So all that can be taken care of by a guy who you have in the finance team, which is actually driving your RevOps operations. A lot of it also is about renewal of those. Are you targeting renewal happening on time? Suppose the renewal is happening on 31st of March. If you go to the customer to talk about it on 31st of March, trust me, the renewal will happen on 1st of April. So you've lost 1 month of cash flow, which could happen earlier. But if you're a RevOps guy focusing on that, you actually save money on that process. Contract structuring and pricing becomes even more critical. So whether will you price your offering by per unit, for founder to figure that out, all of it at an earlier stage is fine. But as you're scaling up, you need to set up your vectors around how will you scale each of those. And it is targeted to specific customer sets and GTMs. So therefore, a RevOps guy comes in handy in terms of managing that entire process. Investor ops becomes critical again in this stage because until now it's more about early stage VCs, all fine with talks about great product, great market, all of that is fine. But now you have to build in cadence around contracts that you have signed with investors and saying, yes, we'll send you an MIS, we'll do track of this thing, we'll get an audit done, but you're still not doing any of that. That will become challenge for you going forward if you're planning to raise more money around Series C, Series D. So investor op guy is very critical from that perspective. You'll also need to follow cadence around managing your ongoing interactions with new investors. It doesn't happen in a day. A lot of those feedbacks keep on going to those investors. So let me use an example to explain why this is required and how it is done. So normally in a sales cycle, especially for enterprise customers, you'll have a 3 to 6 month cycle, if not more. You start a sales motion, you'll get a feedback on your productivity only after 3 months, sometimes 6 months. If your half of the year's budget is gone already, and now you're figuring out how to maneuver your current plan on GTM, maybe you'll not be as productive, and at the end of the year, you'll still not meet your budget. But suppose you did your segmentation of your entire sales motion from lead generation to qualification to conversion, and you did that segmentation by product, by use case, by category, by geography, by customer, by sales lead guy. You can run analytics on that and say, which is a category which works for me, and you can double down every month, and you don't have to wait for 3 months and 6 month cycle. So that's what finance can do for you from a GTM. You can do the same thing on the R&D side of it. So, we have, one of the sponsors here presenting DevRev, great guys. And what they've built a platform is on connecting dev with rev, which is build what your customers are asking for. Now, take that one step further and say, how do I segment that in your existing spend base? And suppose you had a $2 million of R&D budget. In my view, you could segment at the first level saying, R&D required for maintenance of code. Second, R&D required for 2 parts in that, which is customer driven, where one day will not give you revenue, and the other way you make revenue. Where you'll not give revenue will because required for retention itself. You're building new features, you're competing with the market, you have to retain your customers, so you do that for that reason. Second category is customer success. He'll drive you more revenue from more use cases perspective, but again, that's the second category. And the third category can be where I am outward looking, customers have not asked for it, I don't think they know what they need, but I can build on that. But when you drive your capital into these 3 segments, you can start driving productivity around each one of them, and you can keep looking at it every month, whether each of them are performing in a certain manner or not. So you can start prioritizing your R&D motions in each of those streams, depending on the analytics which is coming inside out. You don't have to even look outside for that. So again, that's what finance can do from an R&D motion perspective as well. Now, think of all this in another example which came up in some of my discussions just now with one of the founders. And he was talking about, they're doing very well, growing fast. I think in a couple of $1 million of revenue. Their COGS is roughly 40%. And majority of the COGS is coming from storage and compute cost, AWS, right? So the question is, how do I grow from here? Now, there'll be all discussions about sales and marketing, of how driving more customers and more revenue, but there's no discussion happening around tagging your revenue with your cost. Now again, a finance guy can help you think about it, not accounts, finance guy. And the example there is, can you connect your COGS in a manner where you can, from a unit economics perspective, link it to the revenue from each customer's perspective. Now what can that do is, if of your 40% of the COGS, suppose 30% is coming from specially storage and compute only from AWS, then all you need to do is start discussing with your enterprise customers and say, I'm going to drop down my ARR from you from $100 to up to $60, because that's all I'm making even now, right? I'm making only $60 from you, $40 going into storage and compute. If I do that, then I can drop the 100 down to anything above 60 is a positive for me, because that's what I was making as net. Second, I take away my entire complexity of storage and compute to the customer side. Third, I can now deploy customer success. If I had earlier deployed customer success, and I, by the way, look at sales, account management, customer success, all 3 differently. Customer success to me is about, I'm not expecting more revenue to come from that team. I'm expecting customers to adopt my product using existing software I've already sold for the existing ARR. So actually, customer success literally means somebody working for my customers, but I'm paying for them on my roles, right? So I have to think it like that. And if you think that way, in the example I gave, if I deploy customer success, then those guys will help my customers consume me more. Now, because the storage and compute is on my servers, my gross margin will actually get more squeezed, right? So I'll become from a 60% gross margin, I'll go down to 50% gross margin. But if I've moved my, the storage and compute to the client servers, right? Then actually I'm not only making more net revenue, but also my customer success is driving more margins and more revenue for me. I would rather help them do more and more consumption of my software, right, by the customers, because it is not reducing my gross margin, but actually increasing both my top line and margins. So that's how, again, using finance for segmenting and connecting with the cost and revenue could help drive how your sales motion will be both for customer success as well as for new customers. Another example of this, again, in conversations with somebody else in the conference came up. I have roughly 40,000 users, 8,000 paying, and I have no idea of how to drive NRR from these existing customers. So they do have, say, 5 use cases, but what they have not done is across these 40,000 customers, segmentation into how many customers doing which use cases, which can I tag as my, call it top use case, and then second, third, fourth, fifth. Now, if you do that, you can figure out doing A/B analysis on that, and you can play with that from a pricing perspective with those customers. Which is the second category of use case that I need to use for my, call it the pointed edge of the arrow for doing my next set of marketing. I could not do it earlier, but I can do now. For the same set of users, you can drive that, and actually it'll drive your existing customers, 40,000, that 40,000 will convert into more rather than 8,000, and then 8,000 itself will be more productive from a dollar perspective as well. Another example, I'm just taking examples because more. Now, if you figure out of those 10 use cases, there are 7 which people are anyways not using as much, but there are 3 their usage is very, very high. Then I would put all the 7 into my free model. I'll put only the 3 into my premium model. And the reason for that is 2. One, what I'm trying to drive is my sales and marketing motion. Now, if I make it free and overall, think about a sales and marketing CAC, LTV CAC analysis, or even AICV analysis people normally do, which is $1 spent, and compared to that, how much you're making in a revenue perspective. So the ratio ranges from 1 is to 0.5 is to 1 or 2, depending on how much where you are in terms of your maturity. So suppose for $1 of revenue, you were spending half a dollar of sales, or $1 of sales marketing cost. If you change your $50 into not free, but more make it $10, again linking it to, if for serving those $10 customers, your storage and compute cost or any admin cost on your side was $10, so don't make it 0 and free, but make it $10. Offer those 7 features for those $10, but for the remaining $3, you'll have to pay the $50. Now, doing this helps you in 2 ways. One, you figure out whether in your use cases, is your product efficient, required by people actually or not? And you double down on that and say, tomorrow I can charge $500 for that because I know people will actually pay for this. Versus for the 7 units, you know people will not pay for it. So you reduce your marketing spend on that for sure. You don't pay anything to your customer success anymore or to your sales and marketing guys. And you run analytics on that basically about what will work for you from an economics perspective if you make it free versus not, because you were anyways spending $1 for the, or say $50 for the $50 of revenue coming in. Now you are not earning $40, but you're also not spending 50, right? So you net making $10 more in the process. And if that drives your motion in terms of acquiring more customers, it's greater for you. So again, tagging those in a manner using finance could help you again drive your R&D productivity and sales and marketing productivity as well. I would think of these things more from an operations perspective, but now think of it as from a investor's perspective as well, especially at that stage, right? So what is the investor asking for? Saying, all good until now, growth at any cost is all fine, but especially in these markets and even otherwise as you scale, questions will be more about unit economics. How do you establish that? So if you use that segmentation and tagging using finance in that manner, I think all of that will be easy to present and lay out. From an investor perspective again, what will become more critical is, are you doing enough from a sales and marketing efficiency perspective, an R&D efficiency perspective, and therefore capital efficiency? Because I don't want to put in my $50 million into you for you to just go out and burn. Now, there'll be always some set of companies which are continuing to remain high flyers, and they'll be all able to raise more money without having to care about metrics because of many reasons. It could be because of their background, it could be because of the TAM, and for many other reasons. But I think most of the companies will not fall in that category. So you could take a risk of saying, I will still do that, versus I need to become more thoughtful about myself. You have to think about whether this metrics are driving what is good for me, as in me being the founder, and actually I have the most skin in the game in the process, versus an investor has 20 companies and it'll be fine if one of them do not perform as much. So as you bring that thought process, I think things solve for themselves. The last piece I will say in this is, I would always suggest people around $10, $20 million to not think about valuation multiples as much. And I'll give you an example for that. So what happens is, it's a known fact, as you scale from a $0 to a 1 to a 10 to a 50 and 100, your growth rate will start sliding down, naturally because of the base effect being larger. Now, most of the valuation multiples are driven by your growth rates. So if you've heard of T to D3, right? It's triple twice, double thrice. Now you can't sustain that after, and I'm talking about most of the companies, not one-offs. You can't sustain that beyond a 5, 7, $10 million category. So as you're falling off the growth curve from a T to D3, and your growth rate, and your multiples are gradually squeezing, the questions will be more around, what do you keep chasing? You could still ask for, I still want 30x multiple for my, for my business, but what are you doing in the process is creating your own 20 kilometer per hour treadmill for yourself, right? You could run on it, but choice is, what is the alternative? So now if you think about it, there is a time when there is a inversion happens in the entire matrix. So you'll not always be valued based on revenue multiple. There'll be a time when you are a growth stage company, you are either selling to a large company, to a Vista or somebody else, or you're IPOing, right? At that time, your valuation multiple is more driven by your cash flows, right? So you'll go like this from a valuation perspective, and you'll go down because you were chasing 30x revenue multiples, but as you're transitioning from a revenue to a cash flow multiple, you will have a drop. Now the question is, where would you as a founder sell the business, right? You don't sell at the peak because you can sell only, you want to see it through. You'll sell either around the time when it's already existing, about to be a IPO. So will always be a drop unless you keep finding your S-curves which are driven by either a new product, a new GTM, or whichever. Again, there'll be one-offs, but many companies will fall in that category. The alternative is you can still reach the same valuation outcome, but trying to control the growth rates which are more limited. So you don't have to go for 30x, but you can keep doing, think of this metric, which is, I find very valuable. So every fundraise that you do, try and see that your valuation increases at least 3 times so that the prior investors are remaining happy and you're not on a treadmill to do 10x multiple and then go down to 1x or 2x. So the growth profile of the company is very bad when you do this and down while you're reaching the same space going up in this manner. So again, a lot of it is about capital efficiency and R&D efficiency keep driving. And again, I feel finance side segmentation can drive a lot of those questions.
When you have reached 10 million ARR, your sales and marketing to a large extent is sorted. But in most SaaS companies, the customer success piece, while you have set up your sales and marketing to a large extent, but customer success is not that much.
I think more than about investor discussions, it's more about think about how the businesses are being built, right? So from $0 to $5 million, $7 million, this is the founder driving everything, right? And so at that time, possibly the need for a customer success, a second line of management, a third line of management is not felt as much. It's a lot more based on personal interaction with the customers, right? So therefore, customer success gets happened subconsciously in the process. But now as you're scaling up, you have to set up systems and business, processes to actually make it a business. Until now, yes, it was a business, but to me it is a lot more people driven, right? 1 to 5 people driven. But around the $10 million, you have to set those vectors, otherwise it'll be very difficult for you to scale. The other way to think about it, and I'll come to as to how we engage in what context, because all these are just experience from what we engage with our companies on. So while this $5 to $7 million is happening, VCs as a model can only invest in early stage. VCs can invest in only very high growth companies, right? Now, because of the growth effect, the base effect that I explained to you earlier, many of the companies are in a very difficult spot around this $5 to $10 million category, because not only they have to build their second line, third line of management, which kind of puts pressure on your productivity. You don't have people to guide you and support you on what to do, because they have not done, not all of them have built $100 million businesses in the past. And growing from 0 to 7, 10 versus 10 to 100 are very different categories to grow on. Invest in B2B cross-border enterprise SaaS companies. Normally in this Series C and beyond stage, we'll do some Series B at times, but yeah. And we do $10 to $30 million checks. For companies which are $5 million plus, we start engaging around that time, investing around $10 million. Now, reason we do this in that stage, and we only tend to invest in 8 to 12 companies from the entire fund. We don't invest in 50 companies. Every company has to be successful in our category. We even there invest only in companies that we can engage in all these strategy sessions with our companies. If it's only passive capital, we normally shy away. I'll not say no, but yes, very, very less likely. So given our prior experience on the prior equity side, we try to bring in those building blocks. We sit with founders, segmenting each of these categories. We go into the entire tech architecture, product roadmap, contract structuring, pricing, channel strategy. We do the entire finance tagging piece of it into how to do it, and then make it an internal cycle to drive it. And I think it's been, very well to do that until now. Been very productive. I'll give you an example of that of what we've done with one of the SaaS companies recently. So as a SaaS company, you will think about an architecture perspective. You'll have the front end, your platform layer and the data layer all fused together. That's how you serve, and OpEx-wise, it's much better doing that way. But if you hit your roadblock from a SaaS perspective, normally if it's a data analytics company and data-driven SaaS company, I would suggest to decouple it from the front-end platform and data layer. Now, as you do that, you open up your GTM very differently. So now you can have your SI partners, your channel partners coming and saying, I can come in with my front end, my skin, because they don't want your skin to be done, but they'll be happy to use your platform and your data layer to run the GTM for a certain set of customers. So that their own customers, for example, they could drive that. But there again, if you're doing that, you'll have to focus a lot more on the performance engineering, value engineering, because without doing that, your partners will not be able to perform. You can onboard them, but no adoption will happen. Similarly, in the data layer, what will happen is if you decouple it, if you have a large company like a Walmart coming and saying partnering with you, they would not be very happy with using your front end or platform layer. They would have their own models, they would have their own algos using for running those analytics. So they would come and say, if you have your data pipes laid out, I would be happy to consume that, and then have a mix and match of the model layer and the front end layer. So when we engage on the tech architecture, we do some of these things, driving from $10 million to 100. How do you have to restructure your tech stack even at $10 million to drive some of this productivity? So, but yeah, sorry. I will take questions again.
It's like the context, the product context.
Yeah.
Whether I'm a user productivity tool or am I a tool that depends on a data that gets collected for an organization and I solve a problem across different layers. To the point as to when to invest in a customer success, I would just put a point and maybe want to hear your thoughts. Just purely looking at it from a finance lens, or think about the function, just like you said, customer success plays a role where I have a person in a customer organization helping with adoption, because that is a learning curve that will happen where somebody has to engage with the customer very frequently to ensure the problem statements and overcome those, specifically to be very sound from a financial aspect.
Yeah.
But purely from building a product that solves a problem, at times I believe customer success should be among the first investments.
Yeah, absolutely. And I think it's an equation of what kind of platform you're. But if you're building a platform where you have to a lot more data insights coming in before you kind of roll out the platform, make it usable for people, then you want to build it, whether you call it customer success, whether you call it customer driven product platform development, whichever way you define it. The reason it's called customer success because normally comes as post sales, but what you're suggesting is used as part of product development, of course, initially. Many times I've seen structures where you say, please fund my cost, we'll build it together. They do it for 1 year, and then they roll out to many of the customers. So that happens quite often. But yeah, it's a mix of what kind of product. I believe brain space is even more invaluable, right? So while you may say, I have 1 more hour and I can give it to somebody else and do it, I feel you need to have your free time as a founder to think about many things which you're not thinking right now. So that brain space release is much more critical. Using these analytics, you can drive much more. So for example, you're figuring out, I don't know what's happening with my 20 sales lead that happened last month, and you are consuming your brain space and you don't have an answer. It is a lot more, aggregated answer on what's happening. But with this segmentation, you can know that within minutes and you don't have to put your brain space into it. So think from that perspective as well. So ideas, as you scale, you'll have to release founders' brain space, the CXO team's brain space from things which are more operational. Anything which can be tagged and can be driven through the finance should be done. And this is not about just finance metrics, by the way. It is a lot about operating metrics also. So not about $10 million. And the example I gave about the 40,000 users and the 8,000, it's all about operating metrics more than on finance metrics. So yeah.
Hi. Often when a company is flushed with cash, especially in the later stages, the top leadership slash the founders, often want to expand to other verticals, other geographies, other products.
Give me more value, right? And which is more transaction driven. So you charge me for X units of operations managed for me and bake in your tech cost into it, which is fine. But if you ask me to pay just for the software, normally it'll hit a roadblock very soon. So therefore, you can choose which category. Now, from an investor perspective, what will happen is, if you start the profile of your companies, which is more of a consulting business to start with, let me use consulting work, let me use that money to build a product, and then I'll go out and do some, kind of, build out the company. And then if you want to do that in the US market, there'll be always challenges because whether for good or bad reasons, there'll be always segmentation by every party in the process, including investors. And so, and this is, take it with a grain of salt because it's not like exactly this way happen always, but it'll be always variations to it. But the point is, if you think of a company which is, and you must have heard of $1 million company getting $50 million in the US versus similar company, $1 million struggling to raise $4 million. And the reason is that as to how you build the company, what profile you created, and what is your TAM and how you are structuring the vision piece of it. So those three vectors define where will you do it. You have to keep pressing on more and less depending on who you are.
Thank you so much. Thank you, Rajiv.
Thank you.